Picture this. You wake up on a Tuesday morning, stretch, and grab your phone to check your bank balance. But the app just spins, stubbornly refusing to load. Annoying, but probably just a server issue, right? You head out for coffee, but the card reader at your favorite spot is offline. Then you notice the ATM down the street has a hastily scribbled out-of-service sign taped to its screen. A little weird. The mood on the streets feels tense. Small crowds are gathered outside bank branches, their doors locked tight. Suddenly, that minor annoyance in your banking app feels like the first tremor before an earthquake. The chilling realization hits you like a bucket of ice water. Your money isn't just temporarily inaccessible. It was never really a tangible thing you owned. It was just a series of numbers on a screen. And someone somewhere has just turned the screen off. This might sound like the opening scene of a blockbuster dystopian thriller, but I assure you, it is not fiction. This exact scenario has played out in real life, not in some distant, forgotten corner of the world, but in modern, developed nations where people thought their savings were completely safe. And when the system breaks, it does not gently grind to a halt. It shatters. Overnight, the fundamental rules of wealth, security, and survival are rewritten, and millions of people are left scrambling to understand the new, brutal game they are forced to play. Let us take a trip back to Argentina in the year 2001. After a long dance with economic mismanagement and staggering debt, the government found itself cornered. Citizens, smelling smoke, were frantically trying to pull their pesos out of banks, convert them to US dollars, and get them out of the country. So the government did what desperate governments do. They slammed the emergency brake. They called it the corralito, or the little corral. For ordinary Argentinians, it felt a lot more like a cage. Cash withdrawals were brutally capped at a mere 250 pesos per week. Worse, US dollar accounts were forcibly converted into pesos at a disastrous exchange rate. In a matter of weeks, a lifetime of savings meant for a new home, a business expansion, or a comfortable retirement lost more than half its value. The sound of people banging pots and pans in protest became the new national anthem, a symphony of rage from a middle class that had just been pushed off a cliff. And Argentina was hardly a one-off event. Fast forward to Cyprus in 2013. As part of a bailout deal with the European Union, the government simply froze the banking system. Depositors woke up to the news that a significant portion of any account holding over 100,000 euros would be seized. Yes, literally taken, to rescue the very banks that had failed them. It wasn't just the mega-rich who felt the sting. It was small business owners who could no longer make payroll, retirees whose pensions were suddenly in limbo, and families who couldn't cover university tuition for their young adults. Then there is Lebanon, starting in 2019, where years of systemic corruption led to strict capital controls. No matter how much you had in your account, you were limited to withdrawing a few $100s a month. In every one of these cases, the lesson was identical and unforgiving. The money you thought was yours was, in fact, theirs to control. But surely this could never happen in the United States, the bedrock of global capitalism, right? Wrong. Let us rewind to 1933, during the bleakest days of the Great Depression. President Franklin D. Roosevelt declared a nationwide bank holiday. For 4 agonizing days, every single bank in the country, from the smallest town savings and loan to the biggest Wall Street institution, shut its doors. Citizens couldn't get cash, businesses were paralyzed, and the entire economy was suspended in a state of profound uncertainty. The government had to literally press pause on the entire financial system to prevent its complete and utter collapse. Think about that for a second. The wealthiest nation on earth had to lock down its own money just to keep the whole show from going dark. So, what is the dirty little secret that ties all these crises together? It is a concept that forms the very foundation of modern banking, something we are taught is a marvel of economic engineering: fractional reserve banking. Here is the part they do not advertise in those glossy bank commercials. When you deposit your money, the bank does not neatly stack it in a vault with your name on it. They operate on the principle that only a fraction of depositors will ever want their cash back at the same time. They keep a small percentage, a fraction, in reserve and lend the rest out to create new loans for homes, cars, and businesses. It is a brilliant machine for creating credit and fueling growth, but it is also an incredibly fragile house of cards. This entire system runs on one and only one thing: confidence. It works beautifully as long as we all collectively believe that our money is safe, and the doors will always be open. But the moment that trust begins to wobble, a bank run can start. It is like someone yelling fire in a crowded theater. It does not take everyone panicking to cause a catastrophe. Just enough people rushing for the exits at once is all it takes to create a devastating stampede. Once the whisper of insolvency starts, fear spreads exponentially, and even healthy banks can be brought to their knees by the sheer force of public panic. Governments understand this dynamic better than anyone. That is precisely why, in crisis after crisis, their first instinct is not to protect you, the individual saver, but to protect the integrity of the banking system itself. When Argentina locked the banks, it was not an act of pure malice. It was a desperate move to stop the institutions from bleeding out and collapsing entirely. When Cyprus executed its bail-in, it was sold as tough but necessary medicine. The bitter pill, however, was swallowed by ordinary citizens, who were forced to foot the bill for the reckless mistakes of bankers and politicians. The unavoidable truth is that banks and governments are joined at the hip, and when the ship starts taking on water, they will work together to save the ship, not necessarily all the passengers. This uncomfortable reality is often masked by safety nets and insurance schemes that create a powerful illusion of security. In the United States, for example, the FDIC guarantees deposits up to $250,000. It sounds wonderfully reassuring, does it not? But let us engage in a quick thought experiment. What would happen if a systemic crisis prompted every single American to try and claim that guarantee at once? The insurance fund, which is a tiny fraction of total deposits, would be exhausted in an instant. The true purpose of deposit insurance is not financial, but psychological. It is a powerful placebo, engineered to keep you calm and prevent you from ever thinking about rushing for the exit. And when the banks do shut their doors, the consequences ripple outwards with terrifying speed. Commerce grinds to a halt. Salaries cannot be paid. Supply chains seize up. In Lebanon, factories were crippled because they could not wire money abroad to pay for raw materials. During the 2015 crisis in Greece, life became a daily struggle for cash, with people waiting in line for hours under the blazing sun just to withdraw a meager €60 from an ATM. Life savings, business plans, and future dreams were all held hostage by a system that had decided access to your own money was no longer a right, but a privilege to be rationed out. You might think that in our modern age of smartphones, fintech apps, and cryptocurrency, this old-fashioned problem has been solved. In reality, it has only become more acute. The near-total digitalization of money has made us more dependent on centralized banking systems than ever before. Physical cash offered a last resort, an escape hatch. But today, if the server goes down, if the network is compromised, or if an institution simply freezes your account with a few keystrokes, your wealth is instantly transformed into inaccessible digits in a digital limbo. In a society that is rapidly becoming cashless, a bank shutdown is not some quaint fear from the Great Depression. It is a thoroughly modern nightmare, waiting just off stage. Now, let us really consider the ripple effects. Businesses cannot make payroll, triggering a wave of layoffs. Supermarkets cannot pay their suppliers, so shelves begin to empty. Panic grips the markets, as investors dump assets and drain retirement accounts. What starts as a technical decision made in a quiet boardroom quickly spirals into a full-blown social crisis. The longer the shutdown lasts, the more frayed the fabric of society becomes, as people resort to bartering hoarding, and expressions of profound discontent. This is not a theoretical exercise. It is a historical pattern. And if you believe it could never happen in your country, just remember, those were the exact words spoken in Argentina in 2000, in Greece in 2010, and in Lebanon in 2018. Stability is just an illusion until the day it vanishes. The single most important lesson from these historical crises is that your money is only truly yours until the system decides otherwise. That number you see on your banking app feels solid, real, and secure until the moment it is not. In a world grappling with record government debt, fragile supply chains, and simmering geopolitical tensions, the idea of a bank holiday or strict capital controls is not a far-fetched conspiracy theory. It is a well-established tool in the government's crisis management playbook. And when they use it, they will not ask for your permission. So what can a person do? The answer is not to panic or start stuffing cash under your mattress. History shows that reactionary fear often leads to poor decisions. The real strategy is not panic, but resilience. Diversification is not just a fancy term for investors. It is a fundamental survival tactic. Holding assets in more than one form, across multiple institutions, and perhaps even in different jurisdictions, can mean the difference between total paralysis and having options in a crisis. Things like physical precious metals, real estate, and other tangible stores of value are not relics of an older time. In a shutdown, they could be lifelines. The most haunting part of this entire story is just how quickly confidence can evaporate. Banks do not need to be physically insolvent to fail. People just need to believe they are. The moment that collective faith cracks, a countdown begins that is nearly impossible to stop. And once a shutdown is declared, the mask finally slips. We are forced to see that banks were never neutral service providers. They are pillars of power, deeply intertwined with governments and global markets. In this system, you are not really a customer. You are a participant, and you are participating in a game that works perfectly until it suddenly does not. History may not repeat itself exactly, but it certainly rhymes. The echoes from Argentina, Cyprus, Lebanon, and even the United States are screaming a simple, powerful lesson. Do not confuse access with ownership. If your entire net worth exists only at the mercy of institutions that can lock you out at a moment's notice, then it is not truly yours. The real path to financial security is to look beyond the illusion of safety and prepare for the moments when the system reveals its true, fragile nature. Because one day, the question might not be what if the banks shut down tomorrow, but rather, what do I do now that they already have?